when preparing the financial statement, okay, for us as accountants, we often make a lot of assumptions, okay, which guides us in the preparation and presentation of the financial statement. And all these assumptions that we make is what we call it accounting concept, which are broad base of assumptions. Yeah. Now, the concept, okay, that we employ or we select or we deploy, depending on the school you attended, you determine the grammar that you speak. Consistently is what we refer to what as accounting policy. So they refer to the specific principles, bases, rules, practices, guidelines that an entity deploys or applies in preparing and presenting its financial statement. Think about policy as like normal policy, HR policy, fiscal policy, right? We are looking at the one that has been adopted by the entity. When it comes to accounting concept, we have a lot. We have a lot of them. In fact, when it comes to even the kind of depreciation methods and rate to use and all those things, we have a lot, right? You can do straight line, you can do reducing balance method, you can use output or usage, you can do 10%, you can use 20%. But the moment the entity says for us, we will do 20% straight line, it becomes a policy. In the sense that even when internal auditors or even external auditors come around and you do anything outside the policy, it's seen as a violation or it's seen as a sin, sort of. You get it? So policy is what has been adopted and being deployed or used by an entity. Okay. So it serves as the guidelines, it serves as the rules that everyone, when I say everyone, I mean everyone in the account department, unless maybe the CEO decides to prepare the financial statement. If not, anyone in the account department preparing or presenting a financial statement must comply. The objective of this standard is to prescribe the criteria for selecting and changing accounting policies, together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimate, and correction of errors. Trust me, it happens a lot. We are human beings, so there is a high tendency that you will make mistakes. It's normal. There will be mistakes in the financial statement. There is this popular saying that to err is human. Okay, so sorry, when those errors are being made and later we discover it, what do we do? Should we just leave the financial statement or we should make changes to it? This is some of the things this particular standard seeks to what address. The standard is intended to enhance the relevance and reliability of an entity's financial statement and the comparability of those financial statements over time and with the financial statement of other entities. This actually sits at the heart of financial reporting, comparability. Now, anytime comparability pops up, we have two things. It is either we are comparing the financial statement with that same entity's financial statement over time. So we are looking at 2024, 2023, or we can do that of what our entity with that of what other entities. We can see maybe financing can axiom, right? We are doing those comparability. Disclosure requirements for accounting policies, except those for changes in accounting policies that are set out in IAS 1, presentation of financial statements. Once again, I said this has been changed, just that its implementation is like 2027, thereabouts. Yeah. IFRS 18. So the standard shall be applied in selecting and applying accounting policies and accounting for changes. So one, selecting and applying the policy. Two, changes for the policy, and also changes in estimate. Remember, we said that one of the criteria when it comes to recognizing an asset is that the cost should be measured reliably. Now, down the line, we said in the case where we can't obtain the cost, the standard gives us the permission to do it, to make estimates. So what happens when there are changes to that estimate? We are saying that, oh, the asset is going to last for 5 years. Now, what happens if the asset is not going to last for 5 years? Okay. And also correction of prior period errors. Prior period errors, I mostly see it a lot as an auditor. It's something that if you're an auditor, most likely you'll be seeing it. Okay, so let's look at some definitions from the standard. So accounting policies. So policies are the specific principles, basis, conventions, rules, and practice applied by an entity in preparing and presenting its financial statement. Accounting estimate. So there are monetary amounts in financial statements that are subject to what? Measurement uncertainty. Prior period errors are omissions from and misstatements in the entity's financial statement for one or more prior period arising from a failure to use or misuse of reliable information that A was available when the financial statements for those periods were authorized for issue and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. Retrospective application is applying, let me highlight this because this is an important, it's applying new accounting policy to transactions and other events and conditions as if that policy had always been applied. Retrospective restatement is correcting the recognition, measurement, and disclosure of amount of elements of financial statement as if a prior period had never occurred. Let me explain this whole retrospective thing. So retrospective is just saying that if retrospective application, okay, you have to go back. You go back to the date or the period in which the errors occurred, okay, and you make necessary corrections or adjustments till you get to your current date. You are applying, in the case of a policy, you are applying the policy as if that policy has always been in existence. So assuming we started our business, let's say 2023, okay, and we are in 2025. And let's say we decide to change one of our policies and they are telling us that we should use retrospective application. It means we will go back to 2023 and apply that policy from 2023, 2024, and 2025. So anyone who picks the financial statement will think that, oh, the financial statement, the policy, okay, that was used in preparing the financial statement has always been in existence. So prospective application of a change in accounting policy and of recognizing the effect of a change in accounting estimates, respectively, are applying the new policy to transactions and other events and conditions occurring after the date as at which the policy is changed, and recognizing the effect of the change in accounting estimates in the current and future years or periods affected by the change. So this is the timeline, okay? So this is our current period. So this like today. So bracket today. Okay. Then we have, so to, let's say 2025. So let's just say 2025. Right. Then we have, let's say 2020. Let's say 2020. Then this future, right? So let's say 2030. So after today, okay, we decide to change our policy. We decide to change our policy and we are using the prospective application. So prospective application is that the policy, the change should affect today and future periods. So it means all the financial statements that will be prepared in the middle from today to all the financial statements that will be prepared subsequently will have the new policy in it. So that's prospective. Okay. Then retrospective, I'm saying that we will go back and go and start from the first day. So the new policy will start from 2022 when it comes to the application of the new policy. Sorry, 2020. The application of the new policy will start from 2020 to date. Do we get it now? So retrospective is from, let's say, from day one to future, but prospective is from current to future. Assuming we've been using reducing balance method. Sorry. Okay. So 10, let's say 20% from 2022. Then we got here. Then we said, oh no, let's change it. Let's use straight line. And let's do like 10%. So let's use the prospective application. So we'll just do 10% straight line method for 2025 and subsequent financial statements. But if you are to do retrospective application, retro, let me just write it at the top. Retrospective application, then we would come back to 2020 and start applying this 10% straight line method from 2020. So characteristics of accounting policy. So in devising an accounting policy, it should be 1, relevant to the economic decision that is being made by what? The users of the financial statement. 2, reliable in what? The financial statement. So meaning it should resolve in reliability. Then it should what? Present faithfully the financial position, financial performance, and what? Cash flow of the entity. So if you pick up a policy that will distort the financial information, please, you are out of the picture. 4, reflect the economic substance of transactions, other events and conditions. So other events and conditions, and not merely what? Their legal form. So substance over form. They are prudent and complete in all material respects. So these are your characteristics when it comes to your accounting policy. If your organization is implementing a policy which is not complying with this or having this embedded in it, then I think you guys are using the wrong policy. Every entity has its own accounting policy. Accounting policies may be adopted for a unit of an item, an operation, for like the entire business. In selecting its accounting policies, an entity must first look for the IFRS that deals specifically with the situation. So when you are selecting your accounting policy, first go to our accounting Bible, our IFRS, our IAS, and go and look for the standard that specifically deals with that thing. So if it is revenue, go and look for IFRS 15. If it is lease, go and look for 16. If it is insurance, go and look for 17. If it is investment property, go and look for IAS 40, right? So the standard is that. So your very first, this thing is your IFRS, okay? If IFRS specifically covers the transaction, apply the standard or interpretation, and considering any relevant implementation guidance issued by ISB for the standard or its interpretation. If there are no specific IFRS that deals with that transaction or other event or condition, then management must use judgment, or management must develop judgment in applying this accounting policy. But in doing so, you should make sure that the results that will come from that judgment should lead to a reliable and also provide relevant information. At the end of the day, we want to provide information to the users of the financial statement. So the information should be reliable and it should also be relevant. In making that judgment, management must refer to and consider the applicability of the following source in descending order. the requirements and guidance in ISB standard and interpretation dealing with similar and related issues, the definition, recognition criteria, and measurement concept for assets, liabilities, income, and expense in the framework. Funny enough, all the transactions will fall under this, then maybe capital. So it is easy to get some definitions or get some guidance from other asset standards or liability, right? Management may also consider the most recent pronouncement of other standard setting bodies that use a similar conceptual framework to develop accounting standards, other accounting literature, and also accepted industry practice, to the extent that these do not conflict with the source. I think when it comes to the use of judgment, we've made mention about it in one of our class, that we have standards, but the standard also permits us to make judgments in a case where there are no guidance. If you look at IAS 40, investment property, I don't know if you guys still remember, we said there are instances where an entity may provide ancillary services. That in a case where an entity provides services to an occupant of a property, then we should look at the services, if the service is significant. In a case where the service is insignificant, then the property should be classified as what? An investment property. But in a case where the services is very significant, okay? And I think the standard went ahead to use a hotel as an example. Then the property should be classified as what? Owner occupied property. That will be under IAS 16, not IAS 40. So that's paragraph 11, paragraph 12. Paragraph 13 says that it actually recognizes the difficulty in determining whether the services that is being rendered by an entity is significant or not, because sometimes an entity may transfer their responsibility to third parties. Example, in the case of a hotel, those providing the catering services might be outsourced, cleaning outsourced. So it is even difficult looking at it, that the owner, no, is he really into business, or he just wants to make money out of the property, holding the property for its investment potential. So paragraph 14 went ahead to say that where it is difficult to determine whether it's significant or insignificant, just use judgment. So what it means is that you may have a clear case where there is a standard talking about an item, but when you go into details, you may have to use judgment. So we have IAS 40 for investment property, but paragraph 14 says that where you can determine whether it is significant or not, use judgment. So yeah, once again, if there is a standard talking about it, then that is going to be your go-to. If there are no standards, then you should use your judgment. Just that it should also be in line with some industry best practices and what other accounting standard setting bodies are also saying. Accounting for a change in accounting policy. So now, if there is a change in accounting policy, how do we account for it? If a change in accounting policy is required by a new ISB or interpretation, the change is accounted for as required by that new pronouncement. If the new pronouncement does not include specific transition provision, then the change in accounting policy is applied retrospectively. Retrospective application means the earliest of the prior period presented. Now, before we look at the balances, we are just saying that if there is a pronouncement of new standard, now the standard is saying that we should all run away from IAS 1 and go and embrace IFRS 18. Okay, that's the new pronouncement. The standard is saying that let's apply IFRS 18 using the guidelines provided by IFRS 18, how we should in fact, when we should even apply it. So this IFRS 18, it was developed in 2024 April, so last year, right? Now, if you look at it, so you see the standard gives you what the effective date and also the transition. So that is what the slide is saying, that when there is a new pronouncement, we should use the transition that is being provided by what the new standard. Funny enough, you can see C2, an entity shall apply this standard retrospectively, applying IAS what? 8. So let's look at the effective date. An entity shall apply this standard for annual reporting periods beginning on or after what? 1st January 2027. Anytime there are new pronouncements, then we would go by what? The transition period and effective date in the new pronouncement. Retrospective application means for the earliest what prior period presented. So adjust opening balance of equity affected and adjust opening balance of what other comparative amount disclosed. So in the case of an asset, closing balance becomes what? Opening balance. So you carry the balance to the following period, right? So if there are any errors, it is either you are adding or you are subtracting to or from the balance. So, however, if it is impracticable to determine either the period specific effect or the cumulative effect of the change for one or more prior period presented, the entity shall apply the new accounting policy to the carrying amount of an asset and liability as at the beginning of the earliest period, for which retrospective application is what is practicable, which may be current period, and shall make a corresponding adjustment to the opening balance of what each affected component of the equity for that period. So what the standard is saying is that sometimes it is very impractical or impracticable to start from 2020. So you can do the earliest of the year that is very practicable. If you think 2021 is practicable or 2023 is practicable, then you do 2023. So the earliest of the year that is practicable and the current year. But if you think 2023 is not even practicable, you can only do the current year, then you do the current year. Also, if it is impracticable to determine the beginning of the current cumulative effect at the beginning of the current year of applying a new accounting policy to all prior periods, the entity shall adjust the comparative information to apply the new policy prospectively. So current year, then you take it from there. So current and what? And future periods. Consistency. So an entity shall select and apply its accounting policies consistently for similar transactions. And trust me, the whole reason why we are doing this is because of what? Comparability. So other events and conditions, unless a standard or an interpretation specifically requires or permits categorization of items for which different policy may be appropriate. If a standard or an interpretation requires or permits such categorization, an appropriate policy shall be selected and applied consistently to each category. Once again, in the case of consistency, it's just because of what? Comparability, either over time or with another organization. Imagine that you as probably the FP&A guy, so financial planning and analysis guy in your company, right? Then you obtain a financial statement from the accountant. Today, the accountant is saying, oh, we've used straight line method 10%. Tomorrow, we've used reducing balance method. If you are trying to get a trend with your expenses and make some projections, you will find it difficult. In fact, you wouldn't know what to do, right? So anytime there is a policy or anytime it has to do with presentation, then we are thinking about comparability. We should be able to compare. And anytime we come up with a policy, we should use the policy consistently. I think the standard even gives us the permission to change. All right, so it's not like one policy adopted forever, but the new policy that we are bringing in should give us more reliable information and also more relevant information. And anytime the policy is being changed, you should do what? You should disclose. You have to disclose it in your financial statement. In the case of IAS 40, paragraph 14 that I was talking about, where we have to use judgment, if you read that same 14 downwards, the standard says that in as much as we will be using judgment, the entity should develop a criteria so that that judgment will be exercised consistently within the entity. So applying it consistently is very key when it comes to financial reporting. So changes in accounting policy. An entity is permitted to change an accounting policy if it is required by a standard and is going to result in what the financial statement showing a more reliable information. I think I've spoken about that. So in financial reporting, certain estimates are often made because some degree of what uncertainty associated with those items, in particular and with what business in general. In some cases, judgment is involved in determining the amount of certain items to be included in the financial statement. In the financial statement cannot be measured precisely, like the standard you say cannot be measured reliably. It can only be what? Estimated. For example, an entity may acquire a non-current asset and will need to allocate its cost over what? The useful life. So that's depreciation we are talking about. The useful life and its resulting depreciation remains what? An estimate, as the assets may not even last the exact number of years. Once again, we are not prophets. We are only accountants. So we can just bring up the figure using our judgment and our professional experience. Okay. So accounting estimates can therefore be defined as an approximation of an amount of an item in the absence of what? Its precise means of measurement. Mostly we say cost. So cost, purchase price, import duty, transport, and all those things. But in the case where we don't have the precise means to measure its value, then we can only do what? We can only estimate. Okay. So examples of accounting estimate: allowance to reduce inventory and receivables to their estimated realizable value, net depreciation provision, accrued revenue, provision for deferred tax, provision for a lawsuit, provision or loss on construction contract in progress, provision to meet warrant, and fair value of what? Financial assets or liabilities. I think some of the things have not been dealt with. Some of the things have not been dealt with. We will do IFRS 15, IAS 12, income tax, lawsuit, we will do IAS 37, provisions, contingent liability, and all those things. I think this also 12, 37, then IFRS 9. Yeah. So we will look at them, don't worry. But these are examples. So if you are learning the standard, please. Also, with the way the examiner brings the question, okay, it is advisable that you know these ones. Anytime I give you examples like this, and that is how the examiner these are the things the examiner use in setting your questions, right? So the examiner can pick this one and say that, maybe Josiah met Meshach somewhere and he gave him some blues, then he had some black eye. Then Meshach decided to take him to court. So the lawyers of Josiah are telling him that, there is a high tendency that you'll be made to compensate Meshach. And per their professional experience as lawyers, it is possible that Josiah will pay like 100,000 to Meshach, so he should make some provisions in his books. Okay, so that's an estimate. It doesn't mean the judge will compel Josiah to pay 100,000 exactly. It's just an estimate. So you even realize that we are not, as accountant, we are not the only people who do estimates. Lawyers also do estimates. In fact, even mason guys and contractors, they also do estimates, right? So these are some of the examples or scenarios your examiner will put your questions. So it's possible, it's very important you get to know these examples.